Hi everyone, I'm Patrick Fross with Fross and Fross Wealth Management, and we're passionate about helping people make confident financial decisions by making investing simple, understandable, and goal-focused. Our belief is that you should always know what you own and why you own it. And today I want to talk about how to think about risk tolerance in a smarter, more intentional way. One of the most common questions we get as financial advisors is, how much risk should I be taking? And while feelings do matter, today I want to explain why risk tolerance should really be based on your goals and time horizon, not just how you feel when markets move. When we build portfolios, we don't invest all money the same way because not all money has the same job. Historically, the S&P 500 has been positive about 77% of the time over a 12-month rolling period, which also means it's been down roughly 23% of those periods. That level of risk is simply too high for money you may need in the next year, things like living expenses, planned purchases, or near-term withdrawals. That's why short-term money is often protected in cash, money markets, CDs, treasuries, or similar lower risk strategies. Now, as the time horizon extends, the odds change. Over 3-year periods, the S&P 500 has been positive nearly 88% of the time, which means we can often introduce some growth assets. In over 10-year periods, the market has been positive more than 97% of the time historically. And that's why long-term money, like retirement funds that won't be needed for many, many years, can typically afford to take on more risk and be positioned more aggressively. One of the biggest dangers to a portfolio isn't just market volatility. It's something that we call sequence of return risk. This happens when a client needs to take a large withdrawal during a market downturn. What might have been a 5% withdrawal in a strong market can suddenly become a much larger percentage, forcing the sale of more shares at lower prices and leaving fewer shares to recover when markets rebound. That's why we often use a bucket approach, separating money by time horizon and purpose, to help clients take income while reducing unnecessary risk. So when you think about risk tolerance, don't just ask, how do I feel? Ask, what is this money for? And when will I need it? When your investments are aligned with your goals, risk becomes manageable, intentional, and purposeful. Thank you for watching and have a great day.